Imagine it's 3rd December 2001. You are a 32-year-old journalist living in Buenos Aires, Argentina. Your name is Karina Echegare, and for the first time in years, life feels almost stable. You have money in the bank for a small flat, your children are asleep in the next room, and the city outside your window still sounds like a normal Monday night. The kitchen light hums softly. A half-finished coffee sits cold on the table. In the morning, you are supposed to sign papers that will turn your savings into a home. You have done everything the respectable way. Worked, saved, waited, trusted. The future feels close enough to touch, like a key already resting in your palm. If you have ever wondered why some assets seem to survive every storm while others vanish the moment panic arrives, stay with me. What you are about to hear is not a theory, it is a pattern. It has appeared in Berlin, Buenos Aires, Athens, Nicosia, Beirut, and on Wall Street. And if you find value in this kind of historical clarity, subscribing takes 2 seconds. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Then the decree comes. Cash withdrawals are limited to the equivalent of $250 a week. Bank doors shut, people bang on glass, lines form outside branches like refugees gathering at a locked train station. The money is still there on paper, but paper's no use when the system decides you may not touch it. Within days, anger spills into the streets. Shops are looted. Riots break out. By December, around 40 people are dead in clashes with police. In January 2002, Argentina lets the peso float, the currency falls hard, and the country defaults on $141 billion of debt. By the end of 2002, inflation has surged above 40%. When Karina finally gets full access to her savings later, the flat she planned to buy is gone. She says the money that once could have bought a new life for her children was only enough to buy a car. That is where this story begins. Not with a market chart, not with a clever quote, but with a simple fact that economic chaos exposes again and again. In bad times, wealth is not what you own on paper. Wealth is what still works when trust breaks. And that is why Warren Buffett, for all his calm language and Midwestern patience, has always shown a quiet respect for 5 kinds of assets when the world becomes unstable. Not because they are magical, not because they never fall, but because history keeps returning to them like a compass needle returning north. They are liquidity you can actually reach, productive land, shelter tied to real human use, businesses with pricing power, and essential infrastructure that people cannot simply stop using. Buffett has spent decades saying the same thing in different words. Avoid the sterile stuff. Sterile means lifeless. It just sits there. Own what produces. Own what people need. And keep enough dry powder so that when others are desperate, you are not. Before we go further, there is something important to understand. Economic chaos does not destroy everything equally. It works more like a flood moving through a city at night. It reaches the low streets first, then the basements, then the ground floors, and only later the upper rooms. Some assets drown fast because they depend completely on trust. A bank balance depends on the bank opening. A bond depends on the borrower paying. A currency depends on the state not printing too much of it. When trust cracks, those assets can become claims on a world that no longer exists. But some things stand on different foundations. A field still grows wheat. An apartment still shelters a family. A rail line still moves freight. A good business with pricing power can raise prices without killing demand. Pricing power just means customers keep buying even after prices rise. Pricing power just means customers keep buying even after prices rise, like they do with electricity, fuel, soap, or the one brand they trust. And cash or short-term government bills, if they are held in the right place and still trusted, give you something even more important than comfort. They give you time. Time is the hidden asset in every crisis. Time to avoid selling at the bottom. Time to pay bills while others panic. Time to wait for forced sales. Time to buy what stronger hands are dropping. This is the secret key that unlocks Buffett's worldview. He does not worship assets because they glitter. He respects them because they continue to do a job when the music stops. He has mocked gold for years for exactly this reason. In his 2011 shareholder letter, he imagined all the world's gold melted into one giant cube worth $9.6 trillion. For the same value, he wrote, you could instead buy all U.S. cropland, 16 ExxonMobils, and still have $1 trillion left over. One pile shines. The other pile feeds people, pumps oil, pays dividends, and throws off cash long after the shine has gone dark. That brings us directly to the first asset Buffett quietly respects in chaos: productive land. Not land as a fantasy, land as a working machine. Imagine Germany in 1923. The war is over, but the peace feels poisoned. The government runs deficits, which means it is spending more than it takes in. To cover the gap, it prints money, then more money, then so much money that the currency begins to dissolve like sugar in rain. In 1922, the mark falls from 162 to the dollar to more than 7,000. In 1923, it turns absurd. On 4th of July, $1 buys 160,000 marks. On On October, it buys 242 million. On 25 November, it buys 4.2 trillion. Numbers that large stop feeling real. That is part of the horror. Collapse is not always a bang. Sometimes it is arithmetic so extreme that ordinary language fails first. What did ordinary people experience? Commercial trade gave way to barter. Food riots broke out. The middle class and pensioners watched lifetime savings evaporate. Salaries had to be spent immediately because waiting even a day could mean losing buying power. The money in your pocket behaved like ice on a hot stove. Hold it too long and it disappeared. But not everyone was hit the same way. Britannica's summary notes many businessmen and industrialists made large profits. That sounds cruel, and it was cruel, but it reveals the mechanism. If you owned claims fixed in paper money, you were trapped in the burning building. If you owned productive assets, you were standing closer to the exit. A farm does not care what the banknote says. Wheat is wheat. Potatoes are potatoes. A tenant still needs a roof. A factory still has machines, inventory, and output that can be exchanged for something real. In a currency collapse, the measuring stick breaks. But the thing being measured does not disappear. Now, here's where it gets interesting. This is not just a German story. It is Buffett's story, too, told decades later in a softer voice. When he compared gold with farmland, he was not making a poetic point. He was making a survival point. Productive land converts sunlight, soil, and labor into food. It keeps doing that whether the currency is strong, weak, or ridiculous. That is why a century from now American cropland would still produce corn. The gold cube, by contrast, would just sit there. You can fondle the cube, Buffett wrote, but it will not respond. That sentence matters. It separates appearance from function. In chaotic times, appearances are expensive. Function is priceless. And land was not the only real thing that held up better in inflationary America either. Look at U.S. farm real estate values. According to the USDA, average farm real estate was about $196 an acre in 1970. By 1981, it had risen to $819 an acre. That did not mean every farmer got rich. Debt later crushed many of them in the farm crisis of the 1980s. But it did mean that a real productive asset could move with the storm while fixed paper claims were being eaten alive. Here is something I want you to think about. If your bank account became hard to reach tomorrow, but your income, land, or home still worked normally, which would feel like wealth? Drop your answer in the comments, seriously. Because what I'm about to show you next is the part of this story that most people never hear. This leads to the second part of the story. The second asset Buffett quietly respects in chaos is liquidity you can actually reach. Not theoretical liquidity, reachable liquidity. Argentina taught this lesson with unusual brutality. Millions of Argentines woke up in December 2001 to discover saving inside the system was not safe. The Corralito, as it became known, trapped deposits behind a weekly withdrawal limit. Long queues formed outside banks. Families pounded on closed doors. Supermarkets were looted. Mortgage payments became impossible for many. The country tore through 5 presidents in less than 2 weeks. This is what a banking panic feels like from ground level. It is not an abstract balance sheet event. It is a mother trying to buy food. It is a shop owner staring at locked cash registers. It is a worker learning that the money he spent 10 years collecting can no longer do the job. And yet, even here, some people did better. The BBC interviewed Michaela Restano, who had kept a small amount saved in US dollars. With around $6,000 exchanged at a very favorable rate during the meltdown, she was able to pay off her entire mortgage. Same country, same chaos. In a crisis, liquid assets are valuable because they let you move while others are stuck. They let you pay rent, secure food, or cover debt. Liquidity is the economic version of oxygen. Most people do not think about it until the room gets thin. This is where Buffett becomes easier to understand. People often notice his stock picks. They pay less attention to his weighting. Buffett has always respected the ability to hold cash and near cash. By the end of 2024, Berkshire Hathaway was sitting on roughly $334.2 billion in cash and treasury bills. This is positioning, not panic. He is saying reachable liquidity is a bridge. In Greece, Cyprus, and Lebanon, people discovered possession and access are not the same thing. The pattern is old. When confidence breaks, the system does not fail evenly. It fails by gate. Some people get through, others stand outside with receipts. The deeper lesson is own liquidity that remains credible when institutions wobble. In a storm, the plain umbrella matters more than the jeweled cane. Now we arrive at the third asset, shelter tied to real use. A home, rental property bought for use, not fantasy. This does not sound dramatic. Chaos often hides inside boring things. A roof is not exciting until the rest of the world becomes slippery. Use value means it does a job for you. In unstable times, an asset with direct daily use can become emotionally and economically more important than one with a better return on a spreadsheet. Buffett has often placed homes in a category apart from sterile assets. He understands that some assets earn part of their return in stability. Not all wealth arrives as a dividend. Some of it arrives as fewer points of failure. The middle class usually learns this too late. They accumulate financial claims inside institutions they trust. Then the floor gives way beneath the institution, not beneath the numbers. By contrast, those who hold some of their wealth in direct use assets often lose less dignity. A paid-off home narrows the list of emergencies. That matters more than financial textbooks admit. Before Buffett was the oracle of compounding, he was good at separating what looked valuable from what stayed useful. In chaos, usefulness is a kind of hidden armor. Now observe what all of these cases have in common. They punish dependence on a single fragile promise. The Weimar saver depended on currency. The Argentine family depended on bank access. The borrower depends on stable income and stable credit. When the chain breaks at one point, everything downstream jerks violently. This brings us to the fourth and fifth assets: pricing power and infrastructure. Pricing power means a company can charge more without losing customers. Infrastructure means the pipes, rails, and grids that keep modern life moving. If people must keep buying the service in bad times, the asset has a kind of stubbornness that matters when the economy gets ugly. Buffett wrote about how inflation swindles the equity investor. It behaves like a corporate tapeworm, a parasite that quietly eats inside the host. It forces weak businesses to reinvest more money just to stand still. They need more capital to replace equipment and more working cash. But the best businesses are different. They can raise prices and earnings without needing huge amounts of fresh capital. They are toll bridges, not treadmills. A treadmill demands constant effort to remain in the same place. A toll bridge keeps collecting from traffic that must pass through. You can see this in the 1970s. Prices climbed and annual inflation was 13.5%. That machine changes behavior and makes families rush purchases. Buffett often used See's candy as the mental model. A box costs more, customers grumble, then buy it anyway. That is real pricing power. The other company is trapped in a cycle needing more steel and more machinery just to keep output flat. Inflation does not merely hurt it. Inflation puts weights on its ankles and then asks it to run. This is why Buffett came to love not just good businesses, but good businesses with pricing power and low capital hunger. Low capital hunger means they do not need to swallow huge new amounts of cash every year just to survive. In a storm, that difference is enormous. One boat has leaks, the other does not. And then there is infrastructure. Railroads, pipelines, utilities, energy networks. These are not glamorous dinner party assets. But societies do not wake up one morning and decide to stop using electricity, freight, or fuel. Demand may dip, politics may interfere, regulation may frustrate, but the asset remains woven into daily life like bone under skin. That helps explain one of Buffett's most important habits. He does not just buy growth, he buys inevitability. He wants to own what the economy must pass through: tracks, wires, pipes, insurance float, brands on supermarket shelves. When panic hits, these assets may be bruised, but they are rarely irrelevant. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now look at all three together. Germany in 1923, Argentina in 2001, America in waves of inflation and panic. The same mechanism, different countries, different decades, same result. When trust in paper claims weakens, assets split into two camps. The first camp depends on promises being honored exactly as written. The second camp still does a real-world job even when the promise becomes fuzzy, delayed, devalued, or politically changed. Productive land still grows. Reachable liquidity still buys time. Shelter still shelters. Pricing power still raises revenue. Infrastructure still carries the load. That is the pattern Buffett keeps circling without saying it in apocalyptic language. He is not preparing for the end of civilization. He is preparing for the normal failures of human systems. That is more important. Civilizations rarely vanish overnight. But banking systems freeze, currencies weaken, governments overborrow, markets panic, capital gets mispriced. Those are not black swans. They are recurring weather. This is why Buffett's 2011 attack on gold matters more than many people realize. Gold looks safe because it cannot be printed. Fair point. But Buffett's question was sharper. Does it produce? Does it feed? Does it transport? Does it power? Does it house? Does it throw off cash? If the answer is no, then its protection depends on beliefs, not on what the asset itself does. And that is why his conglomerate is full of railroads, utilities, energy businesses, insurers, consumer brands, and cash reserves rather than piles of metal. He has spent his life choosing assets with metabolism. Metabolism means they do work. They take in reality and turn it into income. At this point, the pattern becomes impossible to ignore. Who gets hurt most in these episodes? Not usually the very rich first. They are diversified. Diversified means spread out. with many doors instead of one. Not usually the very poor first either, because they often have little formal financial wealth left to trap. The first great casualties are often the respectable middle layers of society: savers, pensioners, small business owners, salaried workers. People who believed institutions were sturdy because they had always been told they were sturdy. Weimar Germany was savage to pensioners and the middle class. Their savings were wiped out while many businessmen with real assets could adapt. Argentina's 2001 to 2002 collapse threw millions of middle-class citizens into poverty. Greece's 2015 capital controls turned bank access into rationing by ATM. Cyprus showed that even in the Eurozone, deposits could be turned into rescue material for the system itself. Lebanon showed the same movie in another language, with people technically possessing dollar accounts they could not freely use. This is the human cost of economic chaos. It does not always begin with starvation. It often begins with humiliation. It is the humiliation of asking for your own money, the humiliation of watching a lifetime of prudence behave like foolishness, the humiliation of learning that the rules can be rewritten after you have already played by them. In Athens in 2015, this humiliation had a daily number attached to it: 60 euros. That was the ATM limit as Greece shut its banks and tried to stop the system. Reuters described long lines at cash machines and petrol stations, while anxious shoppers stocked up on essentials. Imagine being a retiree with savings in the bank, being told that your financial life now arrives in handfuls, one small stack of notes at a time. Your wealth has not disappeared on paper, but your control over it has. In Cyprus, the lesson was different and somehow colder. Deposits under 100,000 euros remained protected, but amounts above that line at Bank of Cyprus were hit hard. Major depositors faced losses of around 60%. One day, your balance is a number. The next day, it is rescue material for the system. A threshold becomes a guillotine. In Lebanon, the crisis came wrapped in another illusion. People had dollar accounts. Then they discovered the dollars were more like photographs of dollars. Reuters reported that some depositors expecting to withdraw $1,000 a week were told they could take only $300 or $400. One textile worker said he needed $20,000 before the end of the month for payments and could get only $1,000 each week. That is what systemic stress looks like. Not just red numbers on a Bloomberg screen, a man doing arithmetic against a wall. And this is where Buffett's asset preferences start to look like architecture. He builds structures that do not rely on one beam. Think about 2008. While the global financial system shook, Buffett did not run around shouting. He did what he tends to do. He waited with liquidity. Then he moved into assets tied to cash flow and necessity. In September 2008, Berkshire agreed to invest $5 billion in Goldman Sachs preferred stock. This paid a 10% dividend, plus warrants to buy $5 billion of common shares. In October, Berkshire agreed to buy $3 billion of preferred shares in General Electric. This was again on rich terms, with warrants attached. That was not luck in the narrow sense. It was liquidity meeting panic. The same year, Mid-American bought Constellation Energy. The next year, Buffett would strike his biggest industrial deal ever by buying Burlington Northern Santa Fe, one of the great freight rail networks in North America. Rail, energy, utilities, insurance, consumer brands, cash. None of these are glamorous in the cinematic sense. But in economic storms, glamour is often just fragility wearing makeup. Now notice the deeper truth. The winners in chaotic periods are not always the people who guessed the crisis in advance. Often, they are the people who owned assets with staying power before the crisis arrived. The farmer with useful land, the family with a manageable home, the company with pricing power, the investor with reachable liquidity, the owner of infrastructure that still gets paid because society cannot function without it. That does not mean they feel no pain. It means the pain does not own them. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. So what did the survivors actually do differently? Not the influencers, not the hindsight experts, the real survivors. The historical record shows that those who came through these periods largely shared a few characteristics. First, they owned things with direct use value. Use value means the asset did something for daily life even if markets were closed or confused. A field produced crops. A home provided shelter. A utility grid kept billing. A railroad kept moving goods. In a crisis, an asset that solves a physical problem often outlasts an asset that solves only a financial one. Second, they avoided overdependence on a single institution. This did not always mean they were rich. They did not keep every hope in one bank, one currency, or one promise. The survivors understood, instinctively or deliberately, that concentration is elegant in sunshine and brutal in storms. Third, they kept some form of optionality. Optionality is a big word for a simple idea. It means having choices when others have none. Cash or near cash can create that. So can low debt. So can assets that keep producing income when markets freeze? Optionality is not exciting. It feels almost boring in normal times. Then a crisis comes and boring turns into power. That is Buffett's quiet genius. He rarely sounds dramatic because he does not need to. His balance sheet does the talking. By late 2024, Berkshire's huge treasury bill position was not a statement. It was optionality on an imperial scale. His long dislike of gold is not stubbornness. It is consistency. He would rather own engines and rails than an object that waits for admiration. The best asset in chaos is not always the one that rises fastest during the panic. Sometimes it is the one that lets you remain calm long enough to act, that protects not only your capital, but your judgment. Bring yourself back now to Buenos Aires, to Karina. The tragedy of stories like hers is not that she was reckless. It is that she was responsible in a system that turned responsibility into vulnerability. History is full of people like her. German pensioners, Greek retirees, Cypriot depositors, Lebanese account holders. So what are the 5 assets Warren Buffett quietly respects? Liquidity you can reach, productive land, shelter tied to real use, businesses with pricing power, essential infrastructure, not because they are perfect, but because they keep doing their job after paper promises fail. That is the lesson. Pattern recognition. This is not financial advice. Consult a professional. If one person needs to hear this, share it. Subscribe for more. I will see you in the next one.